I think we can officially call you the best dressed man in both macro and crypto. Urian Timmer of Fidelity. Welcome to the show, Urian.
Good morning. Nice to see you.
All right, we've got a lot to cover here. We kind of had this whole plan of what we wanted to talk about, but we're talking at an interesting time. This is Monday, June 13th, and basically everything is breaking. And it seems a little funny not to comment on what's going on specifically in crypto. I want to talk about Celsius and kind of some of the struggles that's going on there. But it seems like there are a lot of things that are kind of falling out of whack as well. So, Urian, as a guy who's lived through many different market cycles, let's say periods of stress and panic, I mean, walk us through how you're kind of viewing the situation with Celsius. If you just give us an overview of it and how you're kind of digesting all this information in real time.
It's not it's not an organization that I watch closely. As you know, I went down the the Bitcoin rabbit hole about a year and a half ago, and I kind of added Ethereum to it. And then the whole DeFi staking thing is something that I've obviously watched with great interest. But when it comes to Terra, Luna, and these other players, I don't have any inside knowledge. But I think what it shows us is that whole staking part is starting to unravel or is unraveling, and it's a way to suck leverage out of the system, right? I mean, if you think about it, staking is basically adding leverage. As we heard someone accurately describe it, you put money in a box and then you take more money out of a box, and I think that box is kind of being tossed around in the parking lot at this point. So I think the bad news is that when there is stress in the system, whether it's in TradFi or crypto, correlations go to 1. We've seen that many, many times. We see that in every cycle, and in crypto, it appears to be happening there as well. The silver lining is that at the end of the day, there will be no leverage in the system. It'll just be the hodlers, and whoever is left standing is going to have a really attractive opportunity to kind of get involved. But at this point, you're catching the falling knife if you do so. So who knows where the bottom is, whether it's here or whether it's down below. But I've done a lot of extensive fundamental modeling on supply and demand for Bitcoin mostly, and the further we go down below, whatever 40, which I think is kind of the fair value at this point, the more, from my personal point of view, the more attractive it's going to be. But it's certainly very painful to watch it happen as it's happening.
Yeah, I think the big story that everyone is really zooming in on here, and what might be different this time when it comes to specifically crypto, is we've never seen one of these kind of cyclical, crypto turndowns in the face of a global macro turn down as well. And it's been so long since there's been a bear market, at least in US equities, that I think many participants have actually forgotten that is an option. But the setup for macro is pretty ugly right now, right? You kind of started everything off here in this slide deck. We've got, as always, a great chart deck to run through here that Urian has put together for the show. You kind of started everything off here with the rising cost of capital. Can you walk us through what we're looking at here and why this is such an important concept to be paying attention to?
So obviously we have a massive inflation problem. There was a consensus after the last 6 months of the Fed constantly moving the goalpost towards an ever tighter, faster policy reset. And clearly, in retrospect, the Fed, committed a policy error by staying this loose this long, right? They should have ended QE earlier. I mean, easy for me to say in hindsight. I mean, the Fed, I think, deserves a lot of credit for trying to do the best they can in real time. But in retrospect, clearly they were too loose for too long, and they should have started to normalize policy. And now they're trying to put the genie back in the bottle in terms of inflation, which means they now have to overshoot to the tight side. And when you overshoot in terms of policy tightening, you run the risk that you end up breaking something. And I think that's becoming a real concern. The 10-year yield curve is at 6 basis points today. So it's almost inverted again. It briefly inverted, a few months ago. But the Fed is taking the punch bowl away and then some, and it's doing so rapidly. And I think there was a consensus building recently that the inflation numbers would start to improve, at least on a rate of change basis. So the second derivative would at least start to come down from 8.5 to 7 to 6 to 5 to 4, and that at least for now the Fed could kind of go to 3%, which was priced in, and then just wait and kind of see what would happen. And the CPI report last Friday kind of threw cold water or hot oil onto that consensus. And as of this morning, the forward curve, if you look at the SOFR curve, has gone from the low threes to the high threes in the span of, and this chart is one day old, and we can add 30 basis points to that orange line. Right. So it's at 3.9% today. And that means the Fed has to go even at 75 basis points probably this month, and then a 50, and then another 50. So it needs to get to almost 4% within the next 9 to 12 months. And that is a reality that obviously reverberates into all assets, right? If we go back to the previous slide you showed, obviously it infects the bond market immediately because obviously rising rates means lower bond prices. So the 2-year yield, I'm looking at my screen here, is at 3.25 now. It was 2.5 just a week ago. That is a huge reset. Mortgage rates, into the mid fives. And so it affects the bond market. Anyone borrowing money, whether it's a homeowner or a government or a corporate, is immediately affected by this rising terminal rate. But it also affects other assets, including the stock market, because when we look at equity valuation, and I use the discounted cash flow model as a good way to incorporate both the earnings side and the interest rate side, right? Because interest rates matter greatly for equity valuation. The earnings side has not missed a beat, and I don't know if that's just investors whistling past the graveyard, or whether that will change with second quarter earnings season, which will start in a few weeks. But so far, the EPS number for 2022 and 2023, the expected EPS number, is at 10% growth, hasn't budged. The breadth is coming down in terms of numbers of upgrades versus downgrades, but that number is held in. So when you look at the DCF and you put the expected cash flows or earnings in the numerator, that number has been solid. But the denominator, which is the cost of capital, has been rising. And as treasury yields rise and corporate yields rise and credit spreads widen, and right now the high yield OES is at 453, which is not that bad actually historically. But as those two components rise, the cost of capital for equities rises as well. And the cost of capital is defined as the treasury yield, the risk-free yield, although many people might argue with that definition these days, and the equity risk premium. And so as the cost of capital rises, the present value of future cash flows falls, which is another way of saying the PE falls. And maybe if we can pull up the slide where I compare the 2-year yield to the PE ratio. So a simple model is to look at the 2-year yield as a proxy for the Fed cycle. This ruled the game back during the 1994 Fed cycle, when Alan Greenspan just out of the blue raised rates 300 basis points in increments of 50, even 175. Nobody knew what was coming. Has kind of that feel to it this time around. So the 2-year yield was inversely a driver for the PE ratio. And the PE ratio back then during the 94 cycle fell 10 points. We see the same thing happening again. So the orange line is the 2-year yield on a reverse scale regressed against the PE, just to make the numbers relatable. And actually, as of this morning, that number is down to 14.8. So the fair value for how we should value future earnings has gone from about 23 down to 14.8. And you can see this in the last few days, we went from like 16.5 to 14.8. So when you think about why did the stock market fall so hard on Friday and again today, it's because the math has changed. A higher terminal rate for the Fed means a lower fair value for the S&P, and it's an instant repricing, right? So the market's very efficient in pricing in all available information, but that available information is changing by the minute, right? As it always does. So the market is resetting. So, expected earnings for the next 12 months is $232 a share. You do $232 times 14.8, you get to about 2,430 on the S&P. As of right now, we're at 37.75. So the market is derating itself based on this new reality. And from the numbers I just gave you, it doesn't sound like it's done yet.